I've been an ongoing contributor to various news outlets, and that's given me the opportunity to both read and comment on a variety of different reader questions, concerns, and complaints. And in this video, what I want to do today is share with you 3 case studies from real investors with real problems and elaborate further on my thoughts as a fiduciary. Let's get into it. Welcome back to another video from One Up Financial. I am your host, Eric Persogna, CPA, Certified Financial Planner, here to help you increase your income, reduce your taxes, and invest smarter. Let's just dive right into case number 1. Now, all of the information that I go over in this video, I'm going to provide links to the articles below in my blog at oneupfinancial.com/blog. If you want to go directly to MarketWatch, which is actually where I've been commenting on and contributing to read further about these investor questions and concerns and stories. So without further ado, let's get into it. Case number 1, quote, I lost over 21% in 2022. I'm 72, retired, and have worked with my financial advisor for 6 years. I know the markets are down, that was in 2022, but this massive loss is worrying. Shouldn't my advisor have had a plan to manage risk at my age? Simple answer here is yes, obviously, they should have had a plan. And to stick up for the advisor, again, with this case and with the cases that I'm going to discuss in further detail moving forward, I want to say that I don't know the full story here. I only know what the reader shared in his or her question. So I have to make a few assumptions. Based on this question here, I'm going to stand up for the advisor here, at least give them the benefit of the doubt and say that they likely did have a plan in place, probably when the account was established, but they failed to communicate that plan to this client effectively. And that's where the problem, I think, is. And they also, I think, failed to communicate that bonds, which, as we all know, are more conservative than stocks, lost nearly as much as the market did in 2022. And not only did they not explain that, they didn't explain the reasons why. So even if you had a conservative investment portfolio, let's say 40 to 50% in stocks, the rest in bonds. Even if you had a strategy like that, you could have still seen your portfolio decline a substantial amount in value last year. This all leads me to believe that this advisor isn't necessarily meeting or communicating with this investor on an ongoing basis. Something as simple as an annual touch base phone call, email, or even like a newsletter would have probably eased this person's concerns to some extent. Again, assuming, of course, that there was a plan in place, which I'm hoping that there was. A big part of our job as advisors is to be great communicators. It's not enough just to help our clients manage their investments, create and maintain and update financial plans, estate planning, and all the other things that financial advisors do for clients. Those are just a given, I think. They should be a given, at least. A successful advisor-client relationship is built on 2 things. It's built on trust, number 1, and number 2, open communication. And when communication starts to break down, so does trust. And once trust is gone, then so is the client. So I can't stress enough, obviously trust is very important, one of the most important things in an advisor-client relationship. But if your advisor isn't communicating with you on an ongoing basis and communicating with you in an effective way that you understand, then this is how problems like case number 1 here arise. All right, let's go into it. Case number 2, quote, it has been a nearly continuous plunge. My accounts are down 13% this year, but my financial advisor hasn't made a single adjustment and is still taking his 1%. Do I even need this guy anymore? So let me just start by saying that sometimes there is no adjustment needed. It's natural for people to want to take action when there's a perceived problem. Think about it. If we hear our car rattling, for example, what do? We take it to the mechanic. When our drain is clogged, we go to the store and we buy Drano. But if our investment accounts are down, the solution doesn't always involve an adjustment to the portfolio. Unless you're looking to tax loss harvest or simply rebalance your portfolio back to the initial objectives, it might not make sense to quote unquote adjust your portfolio simply out of fear. And I think that may be what's going on here. If you do that, it can lead to developing bad financial habits down the road, such as trying to time the market, which will most certainly hinder your long-term performance. Instead, what I would have liked to see here, and what may have actually solved this problem, or at least alleviated it to some extent, is that adjustment that this client was looking for could have been just in the form of curbing the emotions of a worried client in this example, like calling them up on the phone and talking about what's going on in the market, or simply reiterating the objective of their long-term investment strategy and ensuring that they understand you're watching out for their account, you're keeping a close eye on the markets, and based on everything that you've seen and your understanding of this client in and out, that there is no adjustment, there is nothing drastic that we need to do at this time. I think something like that, even if it was only once a year, might have helped in this scenario. Now, let's go a little bit further here. I think what's going on here, what it sounds like to me, is that this client is looking for their advisor to make some kind of change to their investment strategy to prevent further losses. They don't want to see their account go down any further, so they want their advisor to make a change. And this is a prime example of what's referred to as loss aversion. And that states that investors gain more satisfaction from avoiding losses than they do from actually realizing gains. And if that's true, then I see a couple problems here. So problem number one, I think I talked about it, at least in the first case, and I think it applies here, is complete lack of communication. If maintaining the status quo, right, and not making any adjustment to the investment strategy was the optimal solution for this individual, right, that there was no change that had to be made to this client's investments, then that should have just been communicated to this individual, either through an annual review meeting or, like I said, just picking up the phone and calling this person. The second problem I see could be a potential lack of service. So what do I mean by that? If advisors are charging 1% of a client's investments, then they better be doing a lot more than just managing a portfolio. And that's because the market for financial advice has changed drastically over the years. Fees have come down and services have been enhanced. These are all good things for the client. Now, a 1% fee isn't necessarily unreasonable. In fact, it's actually pretty average if you look across the broader landscape of financial advice. But in order to charge that 1%, there better be some additional value-added services that are being offered to the client, such as, for example, financial planning, retirement planning, tax preparation and/or tax planning, as well as maybe estate planning. So I would guess that those additional value-added services are not being included or not being offered here, and there's just a complete lack of communication. All right, final case number 3. Quote, I finally woke up to reality. I've been paying a percentage of my investments to a financial advisor for years now, but I don't think it's worth it. Is a 1% fee really fair? And I think this plays in a little bit to what I was discussing in case 2, and it's actually a very important question, and I want to go into it in further detail here. So in order to answer this question, I think we need to first answer another question that I think what this person is really asking, and that is, what am I getting for paying a 1% fee to my advisor? And you could probably replace the 1% fee in an advisor for really any service-based business out there. So think about it, is a 1% fee really fair? Well, I could kind of say the same thing, like, is paying $2,500 a year for a landscaping service really fair? Well, I guess it depends, right? If the landscaper stinks and is horrible at his or her job, and I have to continuously call them and they always show up late and they do a horrible job and my lawn looks like garbage, then obviously it's not fair, right? But if they're always on time, they always call me and I don't have to call them, and they make my yard look amazing, immaculate, they save me so much time and headache not having to worry about that stuff, then honestly, in my opinion, it's a great deal. It's totally fair, and I would do it every single year. So again, I think it comes back to that question, what are you getting for that fee? What are you getting for the 1%? I would guess, just like in the scenario before, that this individual is only getting investment management services. So that would make my answer very simple, and that would be no, it's not fair. A 1% fee is not fair just for managing someone's investments and doing absolutely nothing else. And why do I say that? Robo-advisors entered the marketplace about 7 to 10 years ago, maybe a little bit longer, and they entered the marketplace as an algorithm-based portfolio management service designed for cost-conscious clients looking to have their investments managed. That's just another way of saying it's a robot advisor. You go online, you answer a few questions about your risk tolerance, your age, your goals, and the computer algorithm spits out a portfolio. It's managed for you, and it's kind of like a set and forget it kind of deal. So that kind of started about 7 to 10 years ago. And the average fee for that kind of service can range anywhere between 0.28% to about 0.89% of assets under management. So if we kind of just split the difference there, go in the middle, let's just call it 0.5%, right? 0.5% for a robot to manage your investments. Now, if we assume that a human advisor will, over time, generate similar returns to a robo-advisor, then a 1% fee for only managing investments is double the cost of a comparable service, right? Now, there's obviously a benefit to having a human, someone that a client can call on or meet with, especially during times of market volatility like we saw in 2022. Now, I don't know what the value of that is. I know it's probably more than 0.5%, but I can't necessarily quantify that. I think it's different for each individual person. But still, if you're just managing investments and doing nothing else and charging 1% or even more, then that individual, in this case, I think they're correct. I don't think it is fair. In defense of this advisor, he or she could very well be offering additional financial services to this client, but the client either doesn't realize that those services exist or doesn't perceive or feel that there's any value add to any of those services being offered. It could simply just be a mismatch between what the client is looking for and what the advisor is offering. And it's kind of like going to Lowe's and having a salesman sell you on a high-powered lawnmower when all you're looking for is a weed whacker, right? It's just a bad fit. It's not what you're looking for. And some investors just want peace of mind and confidence that their money will last them in retirement and that someone will take care of everything. And for those people, a 1% fee is completely fair. They'll pay it all day. Other people literally need help with every aspect of their financial lives: retirement, investments, estate planning, taxes, you name it. They need help with it. And a 1% fee in their mind might be the deal of a lifetime. Other investors simply just want to manage it themselves, or they feel comfortable outsourcing their wealth management services to a robot, like a robo-advisor, and that's totally fine. But again, I think it all comes down to not just the fee and whether that fee is fair, but more so about what are you getting for that fee? And is it valuable? Do you find value in what services are being offered relative to the fee that you're paying? Thanks as always for watching our videos. If you're interested in staying up to date with our market and financial commentary, please subscribe to our blog at oneupfinancial.com/blog. Hit that subscribe button or follow us on LinkedIn and Facebook. Thanks again, and we'll see you in the next one.